It wasn't a computer glitch. It wasn't a sudden panic in the bond market. It wasn't even a miscalculation by a rogue trader. It was the inevitable mathematical consequence of a weaponized economy. The recent evaporation of $420 billion in wealth is not an isolated event. It is a symptom. The pattern is unmistakable. The arithmetic is merciless. History shows us that when a global hegemon engages in a trade war it cannot afford, the market does not just correct, it retaliates. We have seen the specific sequence of wealth destruction before. It destroys empires not through invasion but through the repricing of risk. Consider the Spanish Empire in the late 16th century. Under Philip II, Spain was the master of the world. Global trade flowed through Seville, but the costs of empire were unsustainable. To fund wars in Flanders, the crown relied on silver from the Americas. When that wasn't enough, they turned to tariffs and taxes on their Dutch subjects. The Dutch retaliated. Trade routes were severed. The Spanish response was the monetary shortcut. They minted the copper vellon. They debased the currency to cover the trade deficit. The result was the price revolution for a Castilian peasant. In the 1590s, the cost of wheat didn't just rise, it became an abstraction. Land values collapsed in real terms because the currency used to price them had lost its legitimacy. The middle class was priced out of existence not by lack of supply but by the destruction of the unit of account. Just like the Spanish Empire, the British Empire faced its own reckoning 3 centuries later. By the early 20th century, the pound sterling was the world's reserve currency. London was the center of global finance. But after the First World War, Britain was indebted and overextended. To protect domestic industry, they turned to protectionism. The imperial preference system was designed to shield British markets. It failed global partners. Retaliated. The pressure on the pound became unbearable. In September 1931, the breaking point arrived. The Royal Navy sailors at Invergordon struck over pay cuts. Confidence evaporated. Britain was forced off the gold standard for the docker in Liverpool or the clerk in London. The wealth stored in sterling denominated assets was repriced overnight. The empire didn't fall in a day, but the wealth of its citizens was quietly transferred away through devaluation. Just like the British experienced, the Weimar Republic offers a brutal lesson in economic warfare. In 1923, the issue was not just printing money, it was a trade dispute turned kinetic. Germany could not pay its reparations. In retaliation, French and Belgian troops occupied the Ruhr, the industrial heart of Germany. They seized the coal and steel. This was the ultimate tariff, 100% confiscation of production. The German government responded with the only tool they had left. They printed money to pay the striking workers in the occupied zone. The currency didn't just slide, it vanished. A middle-class family who had saved for decades found their life savings couldn't buy a loaf of bread. Real assets, like land and factories, were snapped up by those with foreign currency. The domestic wealth was not just destroyed, it was transferred to those who held hard assets outside the system. The pattern repeats in 7 distinct stages. Stage 1 is unchallenged hegemony. The dominant power controls the currency, and the trade routes. Deficits don't matter because the world absorbs the debt. Stage 2 is fiscal overreach, the cost of maintaining the empire. Military bases, social programs, and bureaucracy exceeds the productive output. The debt begins to compound. Stage 3 is the protectionist turn. Facing domestic pressure, the hegemon implements tariffs or sanctions to protect its industries. It views trade as a zero-sum game. Stage 4 is the retaliatory shock. Trading partners do not submit, they retaliate with asymmetric measures, tariffs, export bans, or dumping U.S. treasuries. This is where we see the 70% tariff dynamic. Stage 5 is the liquidity trap. As trade slows, revenue drops. The government must print more to cover the gap. Inflation rises and asset prices become volatile. Stage 6 is the flight to safety. Smart capital realizes the game has changed. Investors sell paper assets and move into tangible value, gold, land, commodities. This triggers the massive wealth destruction in paper market. Stage 7 is the structural reset. The old currency or trade system is abandoned. A new standard is established, often at great Lost to the holders of the old system's debt. Current data suggest we are rapidly transitioning between stage 4 and stage 5, the headline regarding China's 70% retaliatory tariffs, and the subsequent loss of $420 billion in U.S. wealth is not merely a bad trading day, it is the retaliatory shock in action. When a major trading partner imposes a tariff of that magnitude, it effectively renders a vast swath of cross-border commerce mathematically impossible. The inventory that cannot be sold becomes a liability. The companies that rely on that cash flow face a liquidity crisis. The stock market, which is essentially a forward-looking pricing mechanism for future cash flows, must immediately reprice those assets to zero or near zero. That $420 billion did not disappear into a vault. It evaporated because the future earnings it represented were canceled by geopolitical decree. Some economic historians note that this creates a dangerous feedback loop. As U.S. assets lose value, foreign investors who hold trillions in U.S. equities and debt begin to reassess their exposure. The incentive is no longer to hold U.S. assets for safety, but to sell them before the next round of retaliation. This selling pressure forces the Federal Reserve to intervene, likely by printing more money to buy the debt that foreigners are dumping. This brings us back to the arithmetic of the Spanish and Weimar examples. The currency is debased to pay for the trade war. There is a counter-argument often cited by mainstream analysts. They argue that the U.S. economy is too large, too resilient, and too central to the global system to suffer a catastrophic decline from a trade dispute. They point to the strength of the tech sector and the dollar's status as the reserve currency. However, this view ignores the fundamental change in incentives. The risk is not that the U.S. disappears, but that the premium on its assets collapses under the constraints of a 70% tariff regime. The rational move for any global entity is to diversify away from the combatants. We are already seeing this with central banks accumulating gold at a record pace. They are hedging against the exact wealth destruction we just witnessed. The too big to fail argument assumes a static world, but the world is dynamic and capital goes where it is. Treated best if U.S. assets are subject to geopolitical repricing. Capital will flee. The arithmetic does not care about prestige. History suggests three potential endgames for this trajectory. The first is controlled decline. This is the British model after 1945. The empire is dismantled, the currency is devalued, and the nation accepts a reduced role on the world stage. Living standards stagnate, but total collapse is avoided. The second is chaotic collapse. This is the Roman model. In the 3rd century, the currency is debased to the point of worthlessness. Trade networks fracture completely, and the economy reverts to local feudalism. The social contract breaks entirely. The third is reset and restructure. This is the outcome of the Bretton Woods Conference in 1944, the introduction of the Duchy mark in 1948. The old system is wiped out, debts are defaulted on or inflated away, and a new monetary architecture is built from the ashes. This is usually the most painful for those holding the old assets. The only variable is timing, and Payne subscribed for continued analysis of these geopolitical patterns. Focus on education, resilience, and attention to the underlying data rather than the headlines.